All right, buckle up because today we're diving into a piece of business history. It's both fascinating and surprisingly relevant. We're looking at Warren Buffett's 1991 letter to Berkshire Hathaway shareholders.
You might be thinking 1991, isn't that ancient history?
Right.
But trust me, the insights in this letter are timeless,
Yeah.
uh, especially for investors.
Absolutely. What's so captivating about this particular letter is the context.
Hmm.
1991 was smack dab in the middle of a recession,
Yeah,
yet Berkshire Hathaway posted some incredible gains.
right.
Their book value shot up over 39%. So how did Buffett pull that off?
Yeah,
And more importantly, what can we learn from his moves during that turbulent time?
exactly. And here's where it gets even more interesting. Buffett himself admits right off the bat that this level of growth wasn't going to be the norm going forward.
Right.
Berkshire was already getting so big that finding those game-changing opportunities, well, it was becoming a much tougher game.
Yeah, he even puts a number on it. He was saying that in the early days, $1 million profit was a big deal, but by 91, they needed a whopping $370 million idea just to move the needle the same amount.
That really highlights the challenge of compounding at scale, doesn't it?
It does.
The bigger you get, the harder it is to maintain those outsized returns.
Right.
But Buffett, ever the realist, sets a new target, a 15% annual growth rate in intrinsic value.
Sounds achievable, right?
Yeah, 15%. Except to that, they'd need to earn a mind-blowing $22 billion over the next decade.
Talk about ambitious goals.
Yeah, ambitious is an understatement.
But before we get into the nitty-gritty of his investment strategy, there's this fascinating little side story about Buffett stepping in as interim chairman of Salomon Inc.
Oh, yeah?
During a pretty rough patch for the company, I found myself wondering why he'd take on that extra responsibility, when he already had so much on his plate.
It's a great question.
Yeah.
And I think it speaks volumes about Buffett's management philosophy.
Yeah.
He uses this brilliant analogy of a football coach taking credit for a touchdown, even though the quarterback had to throw left-handed because his right arm was pinned.
Oh, wow.
Buffett's point is that Berkshire's operating managers are so talented while they're scoring touchdowns on their own with very little interference from him.
Wow.
This Salomon situation was just him stepping in temporarily to keep things running smoothly.
So it's almost like he's saying, find the best players, give them the tools they need, and then get out of their way.
Exactly. And that's a powerful lesson for leaders in any field.
It is.
Building a strong team isn't just about hiring smart people.
Right.
It's about trusting them to do what they do best.
Okay. So back to those impressive 91 games. Buffett attributes a big chunk of that success to two powerhouses, Coca-Cola and Gillette.
Those are big names.
Big names. He talks about this double dip benefit,
Okay.
where not only were these companies' earnings growing, but the market was also reassessing their value, driving up their price-to-earnings ratios.
And this gets to the heart of Buffett's investment approach. He wasn't just riding a wave. He was betting on companies that were fundamentally undervalued by the market.
Right.
Both Coca-Cola and Gillette had, and still have, these incredible, durable, competitive advantages
Yeah.
that allow them to generate strong returns over the long haul. The market eventually caught up and recognized their true worth, leading to those outsized gains for Berkshire.
It really reinforces the idea that investing is about so much more than just looking at short-term price movements.
Oh, for sure.
You need to understand the underlying business,
Right.
its competitive landscape,
Yes,
and its long-term potential.
absolutely. And this leads us to one of the most insightful concepts in the letter, look-through earnings.
Okay.
It's a bit of a head-scratcher at first,
It is.
but it's essential for understanding how Buffett thinks about value.
Yeah, I have to admit, when I first read about look-through earnings, I had to pause and reread that section a few times.
Yeah.
It's not your typical accounting term. So for those of us who aren't financial wizards, break it down for us. What's the big idea here?
Essentially, look-through earnings represent a more holistic way of evaluating a company's profitability.
Huh.
It's not just about the company's own reported earnings,
Why?
but also includes a portion of the undistributed earnings of its major holdings. Think of it like owning a piece of an apple pie.
Okay.
If the whole pie grows, your slice gets bigger, even if you haven't eaten any of it yet.
That's a fantastic analogy. So Buffett is basically saying, don't just look at the dividends a company pays out. Consider the earnings they're retaining and reinvesting to grow the overall pie.
Exactly. And while Berkshire's look-through earnings actually declined slightly in 91,
Okay.
due to some specific factors within their portfolio, Buffett emphasizes that long-term look-through earnings growth is a vital sign of a company's intrinsic value appreciation. He's looking for companies that can compound their value over time,
Right.
not just deliver a quick buck.
That's such a crucial point for investors to grasp. It's not about chasing the latest fad or trying to time the market. It's about finding companies that are steadily building value over the long term.
Now, let's switch gears for a moment and talk about something that really caught my eye in the letter. Buffett's analysis of the media landscape in the early 90s.
Okay.
This was a time when the industry was undergoing a major transformation, and Buffett had some insightful observations about what was driving that change.
Yes. He talks about how once dominant media companies were facing a decline in profitability, and he attributes this to a shift from what he calls franchise to business characteristics. It's an interesting distinction that I think is incredibly relevant even today,
Absolutely.
especially with the rise of digital media.
He defines a franchise as a business with a product or service that's in high demand. It has few substitutes and is not heavily regulated. These businesses have pricing power and can earn high returns on capital. Think about companies like Coca-Cola, See's Candies, or even Disney. They have that special something that people crave and are willing to pay a premium for.
So those are the kinds of businesses that can weather storms and keep generating profits even when times are tough. What about the business side of things?
A business, as Buffett describes it, relies more on being the low-cost operator or benefiting from temporary shortages in supply to achieve exceptional profits.
Coca.
They're much more vulnerable to competition
Right.
and can be easily disrupted by new entrants or changing market dynamics.
So in the case of media, Buffett was seeing increased competition and fragmentation chipping away at the pricing power these companies once enjoyed. It's like their franchise qualities were eroding.
Precisely.
Yeah.
He even uses a simplified valuation model to illustrate how even a small change in earnings growth expectations can have a huge impact on a company's perceived value.
Okay.
It's a great reminder for investors to really think critically about the long-term prospects of any company they own. Are the underlying fundamentals strong enough to support continued growth?
Right.
Or are they relying on temporary advantages that could disappear?
Speaking of franchise businesses, Buffett spends a good chunk of the letter talking about See's Candies, a company Berkshire acquired back in 1972. I found this section particularly interesting because it's full of little nuggets of wisdom about building a successful business and understanding competitive advantages.
See's is the quintessential example of a business with a durable competitive advantage. It's not just about selling chocolates. It's about selling an experience, a tradition. People associate See's with quality, nostalgia, and gift-giving.
Yeah.
They've built a brand that people trust and are willing to pay a premium for.
And that's where the concept of untapped pricing power comes in. Buffett highlights how See's was able to consistently increase prices over the years without losing customers. They had this incredible ability to capture value because their brand loyalty was so strong.
There's even this amusing anecdote about a new snack food tax in California that perfectly illustrates this point.
Oh, really?
The law was vaguely worded, leading to all sorts of confusion about which foods actually qualified. Apparently, a slice of wrapped pie was taxable, but a whole pie was not. And a Milky Way candy bar was taxable, but a Milky Way ice cream bar was not. Buffett playfully wonders what happens when the ice cream bar melts. Does it suddenly become taxable?
That's hilarious. But beyond the humor, it underscores the importance of understanding the complexities of regulation and how businesses sometimes have to navigate those gray areas. And it makes me think about how See's, despite facing those regulatory hurdles, was still able to maintain its pricing power and profitability.
It's a testament to the strength of their brand and the loyalty of their customers. See's teaches us some valuable lessons.
Yeah.
Identify businesses with enduring competitive advantages.
Okay.
Figure out if they have untapped pricing power, and look for great managers who can execute the plan and navigate challenges. It's a recipe for success in any industry.
And speaking of great managers, Buffett introduces us to another acquisition from 1991, H.H. Brown, a shoe manufacturer. What struck me about this deal wasn't just the company's consistent profitability.
Yeah.
In a notoriously tough industry, but also their unique compensation system.
That's a fascinating approach, isn't it?
Yeah, the key managers at H.H. Brown had their salaries directly tied to the performance of the entire company.
Yeah.
Talk about aligning incentives with shareholders. It's a refreshing contrast to the typical executive compensation packages we often see, which can sometimes prioritize short-term gains over long-term value creation.
I'm curious to hear your thoughts on this. This model seems so sensible. Why do you think it's not more common?
Yeah.
Are there potential downsides that Buffett might not be addressing here?
That's a great question, and it's one I've pondered myself. I think there's a certain level of risk aversion in corporate America
Yeah.
that makes it difficult to adopt such a radical approach. It requires a tremendous amount of trust in your management team and a willingness to share the rewards in a way that many companies are simply not comfortable with.
Yeah.
But the potential benefits are undeniable. When managers are truly invested in the long-term success of the company, they make decisions differently. They're more likely to think like owners and prioritize sustainable growth over short-term profits.
It definitely makes you wonder if there's a middle ground,
Yeah.
a way to incorporate some of these principles into compensation structures without going to such extremes.
Perhaps. But Buffett clearly sees the value in this approach, and it's something worth considering for anyone designing compensation plans.
Right.
If you want your managers to act like owners, structure their rewards accordingly. So as we're starting to see, this letter isn't just about specific investments, it's about a whole philosophy of business and investing.
It really is.
And in that vein, Buffett outlines his criteria for acquiring businesses, a list that's just as relevant for individual investors today as it was for Berkshire back then.
This list is pure gold, honestly.
Yeah. It's like a cheat sheet for finding great businesses.
Right. And it's surprisingly straightforward. He lays out 6 key factors.
All right, let's hear them.
First, the business needs to be large enough to have a meaningful impact on Berkshire's overall portfolio. No tiny startups here.
Right, right?
Second, it needs to have a proven track record of consistent earning power.
Okay.
Buffett isn't interested in turnaround stories or speculative ventures.
No.
He wants to see solid, reliable profitability.
Third, the business needs to earn good returns on equity without being overly reliant on debt. It's about finding companies that can generate strong returns on the capital they invest.
Fourth, it needs to have management already in place. Buffett is not looking to be a hands-on operator. He wants to invest in companies that have capable leaders who can run the show.
And fifth, the business needs to be simple enough to understand. If it involves complex technology or a business model that Buffett doesn't fully grasp, he'll pass. And finally, there needs to be a clear offering price. Buffett doesn't want to waste time haggling. He wants to make swift, decisive deals.
It's amazing how he distills these complex ideas into such a clear and concise list.
Yeah.
It makes you realize that investing doesn't have to be complicated. It's about focusing on the fundamentals and finding quality businesses you understand.
He also mentions his preference for companies run by owner-operators who are looking for liquidity, but want to stay involved.
Yeah.
It's a win-win.
Yeah.
Allowing the original owners to cash out while ensuring continuity and passionate leadership. He even includes a little call to action, encouraging anyone who owns a business that fits this criteria to reach out.
It sounds like he's always on the lookout for a good deal. But even the Oracle of Omaha isn't perfect, and in this letter he revealed a billion-dollar blunder. His decision to not fully buy a large stake in Fannie Mae. What's fascinating about this story is that it wasn't a case of misjudging the business.
Right.
He knew Fannie Mae well, and he believed in their long-term prospects.
Yeah.
But a combination of emotional factors, frustration as the price rose, and a dislike for holding smaller positions led him to make a series of bad calls.
It's a classic example of how even the most brilliant minds can be swayed by emotions. Buffett admits that he let his feelings get in the way of his analysis, and it cost him dearly.
It did.
He estimates that this mistake cost Berkshire a whopping $1.4 billion in unrealized gains.
Wow.
That's a tough pill to swallow.
It is.
It makes you wonder if there's a way to completely remove emotions from investing.
I know.
It seems almost impossible, doesn't it?
It does.
We're all human after all.
You're absolutely right. We can't simply turn off our emotions, but what we can do is try to be aware of our biases. Recognize when they're influencing our decisions, and develop strategies to mitigate their impact. Having a clear investment plan, sticking to your principles, and seeking outside perspectives can help you stay grounded when emotions start to run high.
It's a good reminder that investing is as much about managing your own psychology as it is about analyzing balance sheets. We all have blind spots and weaknesses, and the key is to recognize them and develop systems to prevent them from leading us astray.
Now let's delve into another key theme that runs throughout this letter,
Okay.
the importance of patience.
Okay.
Buffett describes the stock market as a relocation center,
Oh, okay.
where money moves from the impatient to the patient.
He's such a master of analogies. I love that image. So he's basically saying that the market rewards those who can resist the urge to constantly buy and sell, those who can ride out the inevitable ups and downs,
Yeah,
and stay focused on the long game.
exactly. He points to Berkshire's own low turnover in its stock portfolio as an example. They hold companies for years, sometimes decades, letting the power of compounding work its magic.
It's a powerful reminder to tune out the noise and focus on the fundamentals. Find great companies you believe in and let time do the heavy lifting.
And that brings us to the core of Buffett's investment approach, which he succinctly summarizes as find exceptional businesses
Okay,
with durable competitive advantages,
right.
run by talented and shareholder-oriented managers.
It sounds so simple when he puts it like that,
It does.
but finding those superstar companies is the real challenge, isn't it?
He actually addresses that very point.
Does he?
He quotes John Maynard Keynes,
Okay,
another legendary investor,
okay.
who advocated for concentrating investments in a few companies that you truly understand and believe in.
Oh, okay.
Don't try to be a jack of all trades in the stock market. Focus your energy on finding those rare gems that have the potential to generate outsized returns over the long term.
It's a strategy that has certainly worked well for both Buffett and Keynes, and it's something that individual investors who often have limited time and resources can really benefit from.
Absolutely. Trying to analyze hundreds of companies and keep up with every market fluctuation is a recipe for exhaustion
It is.
and often poor decision-making. Instead, focus your efforts on deeply understanding a handful of companies that you believe have a bright future.
This letter is already packed with so much wisdom about investing, business strategy, and even life philosophy.
It really is.
It's amazing how relevant these ideas still are today.
It's a testament to the timelessness of sound principles.
It is.
While the specific companies and industries may change,
Right.
the underlying fundamentals of successful investing remain constant.
Welcome back. I'm still buzzing from all the wisdom packed into the first part of this deep dive into Warren Buffett's 1991 letter. It's like a masterclass in investing and business all rolled into one.
It really is. And we're just getting started. This next section delves into a crucial part of Berkshire Hathaway's success, the insurance business. Now, I know insurance might not sound like the most exciting topic, but trust me, Buffett makes it fascinating.
Okay, I'm intrigued. I've always wondered how insurance fits into Berkshire's overall strategy. It seems so different from their stock portfolio.
It is different, but that's part of what makes it so brilliant. Buffett recognized early on that the insurance business offers a unique advantage.
Float.
Float. Remind me what that is again. It's
Yep.
one of those financial terms that always makes my eyes glaze over a bit.
I hear you. Float essentially refers to the money that insurance companies hold between collecting premiums and paying out claims. It's basically free money that they can invest while they wait to settle claims.
Ah, okay, now I remember. So the idea is that if Berkshire can generate a higher return on those invested premiums than they pay out in claims, they're essentially making money twice, right?
Exactly. And that's where Buffett's investment genius comes in. He's not just an insurance expert. He's a master at finding undervalued assets and generating long-term returns.
Right.
By combining those two skills, he's turned Berkshire's insurance operations into a profit-generating machine.
That makes a lot of sense. But Buffett also mentions that traditional metrics for evaluating insurance companies, like the combined ratio, aren't always the best indicators of Berkshire's performance. Why is that? The combined ratio measures the profitability of an insurance company's underwriting operations. It essentially tells you how much they're spending on claims and expenses for every dollar of premium they collect. A combined ratio below 100% indicates an underwriting profit, while a ratio above 100% means they're losing money on their core insurance business.
So if Berkshire's combined ratio isn't always a reliable metric, what does Buffett focus on instead?
He looks at what he calls the cost of funds developed from insurance, or simply the cost to float. It's essentially the difference between the return Berkshire earns on those invested premiums and any underwriting losses they incur.
So the goal is to keep that cost of float as low as possible, ideally even negative.
Exactly. And Buffett proudly reports in the letter that Berkshire consistently beat the government's rate on long-term bonds in 20 out of the 25 years they've been in the insurance business. That's a pretty impressive track record.
It sounds like they've cracked the code. But he also emphasizes that the challenge is to keep growing that float while maintaining a reasonable cost. It's all about finding that balance.
It's a delicate dance, for sure. And within the insurance realm, Buffett highlights a particularly interesting and risky area, super cat insurance.
Super cat. Is that like insurance for superheroes?
Not quite, though it does involve dealing with some pretty extraordinary events. Super cat insurance is essentially insurance for other insurance companies. It protects them against catastrophic losses like hurricanes, earthquakes, or major terrorist attacks.
Ah, okay, so it's like insurance on steroids. High risk, high reward.
You got it. What's unique about this business is its extreme volatility. You can have a year with no major catastrophes and make a killing, or you can get hit with multiple disasters and suffer significant losses. The key, as Buffett emphasizes, is to have the financial strength to withstand those inevitable swings.
I can see why this would be appealing to Berkshire. They're known for their deep pockets and their ability to take on risks that others can't.
Exactly. And Buffett points out that Berkshire benefits from the fact that many other reinsurers have retreated from the supercat market after suffering big losses in the 1980s.
Oh, okay.
This reduced competition means more favorable pricing for Berkshire.
So they're taking advantage of a market inefficiency, essentially.
Precisely. But Buffett is also realistic. He predicts that this dynamic won't last forever. Eventually, insurers will forget the pain of those past losses and flood back into the market, driving prices down.
Right.
It's the classic cycle of fear and greed.
It's a good reminder that no market advantage lasts forever. You have to constantly adapt and evolve to stay ahead of the game. Now, shifting gears a bit, the letter also touches on Berkshire's fixed income investments.
Right. And this section reveals something interesting about Buffett's approach. He's known for his focus on stocks, but he certainly doesn't shy away from bonds when he sees an opportunity.
So what kind of bonds was Berkshire holding at the time?
Their largest holdings included bonds issued by companies like American Express, Champion International, and Salomon. He notes that these investments have performed well overall, generating both substantial capital gains and attractive yields.
But I'm guessing it wasn't all smooth sailing, right? Even in the seemingly stable world of fixed income, there can be surprises.
Absolutely. And Buffett recounts the unexpected situation with Salomon, which had faced a major scandal and required his personal intervention.
Oh, wow.
He doesn't go into great detail about the specifics of the scandal, but he does acknowledge that it was a stressful and time-consuming ordeal.
It's a reminder that even in seemingly safe investments, there's always some level of risk. And speaking of risk, Buffett also addresses a particular investment that was facing some serious headwinds, U.S. Air.
Ah, yes. The airline industry, a notoriously tough business, even for the best investors.
He had invested in U.S. Air a couple of years earlier, but the industry was in turmoil. Multiple airlines had declared bankruptcy, and the whole sector was bleeding money.
Buffett acknowledges that the risk of further industry-wide losses was very real, and he reflects this concern in the low valuation he assigns to the U.S. Air investment in the letter. He points to the challenging dynamics of the airline business, with intense competition, high fixed costs, and a history of boom and bust cycles.
It's a classic value trap.
It is.
A company might seem cheap based on its current earnings.
Yeah.
But if the underlying industry is fundamentally flawed, well, it can be a recipe for disaster.
Exactly. But despite those challenges, Buffett expresses a degree of confidence in U.S. Air's CEO, Seth Schofield, who is taking steps to improve the airline's chances of survival.
Okay.
It highlights a key aspect of Buffett's investment philosophy, betting on talented managers who can navigate turbulent times.
He's not just looking at numbers on a balance sheet. He's looking for people he believes in, people who can make tough decisions and guide a company through rough waters.
And this leads us to another fascinating aspect of the letter.
Okay.
Buffett's reflections on corporate governance and philanthropy. He discusses Berkshire's Shareholder Designated Contributions Program, which allows shareholders to direct a portion of the company's charitable giving to organizations of their choice.
I love this concept. It gives shareholders a voice in how the company's money is being used to make a difference in the world.
Exactly. And Buffett emphasizes that while Berkshire supports a variety of charitable causes, the company does not use its funds for national programs or activities of special personal interest to its managers or executives.
So no pet projects or vanity donations.
Right. He believes that if employees want to donate to their alma maters or other personal causes, they should use their own money, not the company's.
It's a principled stance that reflects Buffett's belief in aligning incentives and ensuring that charitable giving is driven by genuine personal commitment, not corporate self-interest.
Now, before we wrap up part two, there's one more interesting tidbit I want to highlight. Buffett's reference to his partner Charlie Munger's annual letter to Wesco
Oh,
shareholders.
yes, the dynamic duo. I always enjoy reading Munger's letters as well.
Oh, me too.
He has such a unique and insightful perspective on the world.
He does. But in this case, Buffett notes that for the first time in a while, Munger's letter was not included in the Berkshire report because it was relatively bare bones this year.
Bare bones. That's not like Munger at all. He's usually overflowing with ideas.
I know. It makes you wonder what was going on that year. But even though Munger's letter was missing, Buffett still encourages Berkshire shareholders to get a copy of the Wesco report, highlighting the value he places on Munger's insights.
It's a testament to their long-standing partnership and the mutual respect they have for each other's thinking. They might not always agree on everything, but they clearly value each other's perspectives.
It's a beautiful partnership and one that has undoubtedly contributed to their incredible success.
Well, this has been an incredibly insightful journey so far. We've covered everything from the intricacies of insurance to the importance of talented management to the power of patience in investing. What else can we expect in the final part of this deep dive?
In the next section, we'll explore some of Buffett's broader reflections on the art of investing and his advice for navigating the ever-changing market landscape. We'll delve into his thoughts on common stock holdings, his approach to dealing with mistakes, and some of the timeless principles that have guided his success over the years.
I can't wait. It's like getting a sneak peek into the mind of one of the greatest investors of all time.
Welcome back to our deep dive into Warren Buffett's 1991 letter to Berkshire Hathaway shareholders.
We've already uncovered so many gems about insurance, investing, and even a bit of philanthropy along the way.
And now in this final part, we get to explore some of Buffett's broader reflections on the art of investing and his advice for navigating the ever-changing market landscape.
He kicks things off by discussing Berkshire's common stock holdings, which at the time included some familiar names like Capital Cities ABC, Coca-Cola, Geico, Gillette, the Washington Post Company, and Wells Fargo.
What struck me about this section is how few changes Berkshire made to its portfolio in those days. They had this Rip Van Winkle approach, holding on to those companies for years, sometimes even decades.
It's such a contrast to the frenetic pace of trading we often see today, isn't it? It's like everyone's trying to time the market perfectly, jumping in and out of stocks at the slightest provocation.
Exactly. And Buffett argues that this stay-put behavior is a reflection of their belief that the stock market is essentially a mechanism for transferring money from the impatient to the patient.
I love that analogy. It paints such a vivid picture of how those who can resist the urge to constantly tinker with their portfolio are ultimately rewarded.
He even makes a playful jab at the energetic rich,
Yeah.
those who are always buying and selling, often to their detriment, contrasting them with the idle rich who patiently hold on to their assets.
It makes you wonder if all that trading activity is really just a form of entertainment for the wealthy.
Perhaps there's an element of that. But Buffett's point is that successful investing isn't about trying to outsmart the market or predict every twist and turn. It's about finding great companies and letting time work its magic.
And looking back, it's clear that the patient approach has paid off handsomely for Berkshire and its shareholders.
It really underscores the importance of tuning out the noise and focusing on the fundamentals. Find great businesses you believe in and have a conviction to stick with them through thick and thin.
Buffett then reiterates his core investment philosophy, which he describes as searching for large businesses with understandable, enduring, and attractive economics, run by capable and shareholder-oriented managers.
It's a simple formula. But finding those superstars, well, that's the real challenge, isn't it?
You're telling me. It makes you want to go out and scour every corner of the market, looking for those hidden gems.
Buffett actually addresses that very point. He quotes John Maynard Keynes, who advocated for concentrating investments into few companies that you truly understand and believe in.
So it's not about diversifying for the sake of diversification. It's about focusing your energy on finding those rare companies that have the potential to generate outsized returns over the long term.
Exactly. Don't try to be a jack-all-trades in the stock market. Focus your energy on finding those rare gems that have the potential to generate outsized returns over the long term.
He even makes a rather memorable analogy saying that calling institutions that trade actively investors is like calling someone who repeatedly engages in one-night stands or romantic.
Classic Buffett wit. It's a reminder that true investing is about building lasting relationships with companies, not just flitting from one fling to the next.
He then goes on to describe how he would approach investing if his options were limited to private businesses in his hometown of Omaha.
This is where his true genius shines through. He says he would first try to understand the long-term economics of each business, then assess the quality of the management team, and finally, try to buy into a few of the best operations at a reasonable price.
It's such a simple and logical approach, yet so many investors get caught up in the complexities of the market and lose sight of these fundamental principles.
He sees no reason to deviate from this approach when dealing with publicly traded companies. It's all about applying those same principles of business analysis, regardless of whether the company is private or public.
Now, towards the end of the letter, Buffett returns to a topic he had addressed a few years earlier, his investing mistakes. He had promised to provide an update on his blunders in the 1989 annual report, but he delivers on that promise a bit earlier than expected.
Oh.
He jokes that if he waited until his originally planned 2015 update, his backlog of mistakes would be too long to manage.
Always a good time for a bit of self-deprecating humor.
But beyond the humor, there's a profound lesson here. He says that his biggest errors tend to be sins of omission rather than commission.
So it's not about making bad bets, but rather about failing to act on opportunities that he and Charlie Munger recognized as clearly attractive.
Exactly. It's a classic case of letting fear or indecision paralyze you into inaction. And he provides a particularly striking example: his failure to fully purchase a large stake in Fannie Mae back in 1988.
As we discussed earlier, Buffett understood the business, believed in the management team, and saw the potential, but he let those emotional factors get in the way.
He admits that he stopped buying as the price rose, and in a moment of irrationality, even sold the shares he already owned.
It just goes to show that even the most brilliant minds can be swayed by emotions.
Absolutely. And the cost of that mistake was significant. He estimates that it cost Berkshire a staggering $1.4 billion in unrealized gains.
It's a stark reminder that even the greatest investors are not immune to making mistakes. And sometimes those mistakes can be incredibly costly.
But the key is to learn from those experiences and strive to make better decisions in the future. As Buffett himself says, the only way to avoid mistakes is to do nothing, and that is the biggest mistake of all.
This letter is a treasure trove of wisdom and insights, offering timeless lessons on investing, business strategy, and even the importance of acknowledging our own fallibility.
It's a must-read for anyone seeking to navigate the complexities of the market and build lasting wealth.
It is, and it's surprisingly accessible.
If you haven't already, I highly encourage you to read the full letter and reflect on how these principles can be applied to your own investment journey.
And until next time, remember, as Buffett so eloquently put it, the stock market is a relocation center where money moves from the impatient to the patient. So stay focused, stay disciplined, and happy investing.